Real estate prices in Germany have gone through the roof in the last years, and now the bubble is gonna burst and the German real estate market is going to crash. Really? That's at least what a lot of people in the mass media are saying all the time. We discussed the bubble argument and the future of the German real estate market in many videos already, so today we want to focus on the real return of German properties. Was it really that insane as everybody says all the time? And not just over the last 10 years, but if we actually look back 50 years. That's what we'll see in this episode of the GermanReal.Estate blog. The German Economic Institute compiled the real return of the German real estate market since the year 1970. The full study is linked in the blog post on our website in case you want to take a deeper look yourself. For everyone else, let me tell you what the German Economic Institute did. They calculated the total return of German properties by adding the two factors that matter most when investing in real estate. Return on rent, dividing the yearly rental income by the purchasing price of the property to see how much passive income the property is actually creating. And second, the increase in property value, or decrease of course in times of falling real estate prices. Before we see the chart, this might sound a little counterintuitive, but stay with me, it's important to understand. A positive total return does not mean a positive real-life return from your real estate investment. Why not? Well, imagine you invest in a property and get a 1% return on rent plus 1% increase in property value. Way too low, which you will see in a moment, but the question is, did you make a positive real-life return now? No. As a real estate investor, you have to maintain and renovate your property. That costs money. You probably have a mortgage with an interest rate that increased significantly last year. That costs money. And you have inflation that increased pretty significantly as well last year. And that is why Professor Vogtländer, who made the chart, is valuing only a total return of at least 3% as a real-life positive investment return. Everything below 3% means you probably made a loss with your real estate investment. Alright boys and girls, here's the chart showing the real return of the German real estate market after inflation. The 2020s, that didn't start that well for real estate, am I right? Show, despite all the craziness with COVID, inflation and the war in Ukraine, an insane return of 12.3% in 2020 and 10.6% in 2021. I wonder what the numbers for 2022 will be. And if you want to know that as well, you might want to subscribe to our channel to stay on top of all the latest news about the German real estate market. So summarizing the 2020s, 11.5% average return over the 2-year period after inflation. So even if you factor in the 3% costs to own real estate, you are left with an 8.5% rate of return after inflation. Pretty insane if you ask me. If you want to profit from the resilient German real estate market, that's the title of the study by the way, then you might want to invest in our real estate security tokens that we offer on our GermanReal.Estate marketplace. This is a much easier and much more affordable way to invest in German properties than anything else. Let's see the 2010s, the golden ages for real estate apparently, with insane growth rates and exploding rents. Is that so? Let's see what the German Economic Institute came up with. 2010 didn't start that well, coming straight out of the global financial crisis. But we still had a 3.4% total return, so 0.4% real-life positive return from investing in real estate. Which is a big difference compared to US house price index, which shows about minus 10% in 2010. I guess the title of the study, Resilience of the German Real Estate Market, is as right as it can be. Even in the biggest financial crisis of our generation, investors still had a positive return when investing in German real estate. Over the rest of the 2010s, property returns went up and up and up to the maximum of 11.7% return in 2016, leaving us with a 8.1% average return of German properties in the 2010s, per year after inflation of course. And if you would factor in the return on equity because of the leverage with your mortgage, woo! In the 2000s, we see for the very first time a real-life negative return multiple times even. 1.5% in 2001, 1.8% in 2004, and only 1% in 2007, which was of course the start of the global financial crisis. And those 3 years are also the reason why German real estate returns in the 2000s grew on average only 3.8%. It's still pretty good. Over the last 20 years, you would have always made a positive return when investing in German real estate, even after costs, inflation and everything. But still significantly less than in the 2010s or 2020s. 1990s were better again, with only 2 years that are below 3% total return. So no wonder total returns over the decade increased to 4.5% again. Even with the German reunion and the cheap Ostimmobilie, property prices went up nicely. But that's nothing against the 1980s, because here we have negative total returns for the very first time. Not just real life negative, but total return positive, like the bars below 3%, negative in both for the very first time in 1982 to 1984. Anybody of you good in history and knows why? The second oil price crisis, as we call it in Germany, started in 1979. And shortly thereafter, the Iran-Iraq war in 1980. This goes to show you that the German real estate market reacts to news much slower than the stock market if it takes at least 2 years to lead to negative returns. 1970s were pretty similar to the 1990s coincidentally. 2 years with a total return below 3%, and the average total return over the entire decade is 4.5% per year. After seeing the real return of the German real estate market over the last 50 years, there's only one more question left to answer. Why is the German real estate market so resilient? I mean, compare it with the stock market or real estate markets in other countries. It's insane how stable and profitable the returns have been. The German Economic Institute gives us 3 reasons. First and foremost, the conservative way mortgages are handled here in Germany. While other countries fix their mortgage rates only for the short term or have variable mortgage rates, the UK or Spain for example, we fix interest rates for usually 10 years or more. So the recent interest rate hikes are only relevant for people that want to get a mortgage right now or people that have financed 10 years or more ago. And 10 years or more, we had an interest rate of 3% or 4% anyway. I know everybody's making a huge deal out of the interest rate, but the German real estate market doesn't give a f. Second, which goes hand in hand with fixing mortgage rates over the long term, German real estate investors have a long-term mindset. They better actually, because closing costs in Germany can be easily 10% on top of the property value, which you need to recoup to be just at zero again. And of course the tax-free speculation period of 10 years. When you hold a property for more than 10 years, you can sell it completely tax-free, even if you made millions. If that's not a good reason to start investing in German real estate today, I don't know what is. And last but certainly not least, the argument that we bring over and over again. The German real estate market is extremely diverse. There is not one German real estate market, and that makes it so resilient as well. The UK and France are very focused on their capitals, London and Paris. If something would happen to these 2 cities, both countries would have a huge problem. Germany is different. In our capital Berlin, you have the startup culture. In Frankfurt, you have our finance city, maybe even the financial center of Europe. Hamburg is logistics. Cologne and Düsseldorf, where we launched our first 2 real estate security tokens, are more manufacturing. Stuttgart is all about cars. Every single one of our top 7 A locations has its unique benefits and is competing with the other 6 cities. So if something would happen to one of the top 7 cities, it wouldn't be great, don't get me wrong, but the overall German real estate market would probably be fine as people would move to a different A location. And that is why the German Economic Institute believes that German real estate can be a great investment, if done right of course. And that is what we believe as well. So why don't you hop over to our website and start investing in real estate in Germany right now?